Hello and welcome to our webinar on COVID-19 and the state of the New York City market. I'm Amanda Aaron, president of the Metro New York chapter of the Appraisal Institute. We're thrilled to co-sponsor this webinar with the New York Metropolitan chapter of the Counselors of Real Estate. We have a great lineup of speakers for you today addressing the major market sectors impacted by this unprecedented economic and social upheaval. We'd also like to thank the sponsors of our chapter who make programs and events like this one possible. Just before we get started, a couple of notes on the technology. All attendees of the webinar are muted and will remain muted for the duration of our program. For those of you who are on PCs, there's a panel on the right-hand side of your screen which you can pop out with a little orange arrow and pop it in and out. And there is a place for you to submit that allows you to submit questions for panelists as they speak or at any time during the webinar. We have a full program, but Patrick Craig here of our appraisal chapter will be monitoring these submitted questions, and we'll try to address a small portion of them with each speaker as time permits. The slides from today's presentation will be made available to you as handouts, and the presentation is also being recorded for future viewing. So welcome, and I will now turn it over to Neil Madsen of the CREs.
Thanks, Amanda. I'm Neil Madsen, this year's chair of the New York Metro chapter of the Counselors of Real Estate. The Counselors is an international organization of high-profile property professionals, which include principals of prominent real estate, financial, legal, and business advisory firms, as well as recognized leaders of government and academia. We're a diverse, seasoned group encompassing a variety of backgrounds: developers, investors, appraisers, brokers, attorneys, financial experts, portfolio and pension fund managers, architects, etc. We're pleased to be co-hosting today's event with the Metro New York chapter of the Appraisal Institute, and it's my honor to introduce today's first speaker, Mark Zandi. Mark is chief economist of Moody's Analytics, where he directs economic research. Moody's Analytics, a subsidiary of Moody's Corp, is a leading provider of economic research, data, and analytical tools. Dr. Zandi is a co-founder of economy.com, which Moody's purchased in 2005. The last time I introduced Mark was on January 31st at an annual breakfast co-hosted by the same two New York Metro chapters. And while Mark identified coronavirus as a possible risk factor for 2020, I don't think any of us at that breakfast imagined it would take on the proportions confronting us today, less than 90 days later. So like all of you, I'm eager to hear Mark's thoughts on the economic ramifications of this global pandemic. Welcome back, Mark.
Thank you, Neil. Thank you for the opportunity, Amanda. Appreciate it. I have, I think, about 15 or 20 minutes, and I have a few slides. I'm not going to go through all of the slides. They're there for you. Maybe I'll use a few along the way, and then we'll have a few minutes for some Q&A after that. My talk has three parts to it. Part one is just a framework for trying to understand how the virus is going to impact the economy. Part two is my baseline, most likely view of how this is all going to unfold. And given that there's a lot of uncertainty here, things can go down lots of different paths. Part three will consider some of the risks, the things that we need to watch out for to gauge which way things are headed. Okay, part one, the framework. This is the virus is both a supply shock to the economy and a demand shock, which is atypical, unusual, unprecedented, off the rails, very, very different. I mean, the only thing that comes even close is a natural disaster, a hurricane blowing through the Florida Peninsula, knocks out businesses for a few days. But, you know, that's a few days, and, you know, there's going to be sunshine on the other side, and you know when that's coming. So this is something that is just very different than anything else we've ever experienced. The supply shock is very significant. The shutting down of businesses now encompasses roughly the output of almost 25 to 30% of GDP. So 25 to 30% of the nation's GDP is on some form of business lockdown. In fact, you can see that in the first slide if you move forward. This gives you a sense of the magnitude of the supply shock, just broken down the impact on GDP by industry. You can see that the apex of the supply shock is actually this month, the month of April. And in fact, it does feel like we are now going to start seeing some business reopenings very shortly. Some southern states are already moving down the path. And as you can see from the forecast here, looking forward, May, June, July, August, I do expect more business reopenings in May. And by July 4th, the bulk of businesses will be reopened. There's some businesses that just won't until we have a vaccine or a treatment we're all comfortable with, where there's a lot of big social gatherings. That's just not going to come online until we have that vaccine. The supply shock is evident in the labor market. And again, April is going to be the apex of the hit to the job market. Right now, it looks like employment for April will be off somewhere between 20 and 25 million workers. So we're going to see 20 to 25 million lost jobs in the month of April. That's motivated by this chart on claims for unemployment insurance, and you can see for the last 4 or 5 weeks, if you add up all of the claims, it's now 23 million. Not all those claims are going to, these are applications, not all of them will be approved, but nonetheless, it gives you a pretty good sense of the magnitude of the hit. Unemployment, that'll in April end up being somewhere between 15 and 20%. That belies the stress, because we will see a lot of people that will be pushed off out of the labor force. To be counted as unemployed, you have to not be working, but you also have to be looking actively for another job. Of course, for many people, that's not possible. So they'll be not counted as unemployed now in the workforce. So a better measure may be the U6 underemployment rate, which could be somewhere between 25 and 30%. These are kinds of underemployment we haven't seen since the 1930s Great Depression. So the supply shock is massive, unprecedented, and we're now experiencing the peak of that shock literally right now in the month of April. There's also a demand shock, a demand side shock. That's typically the kinds of recessions we've experienced since World War II, the demand side shocks. Part of that's related to the lost jobs. In addition to the lost jobs, you have a lot of people losing hours and losing wages. And of course, all that lost income means consumer spending weak. There's going to be wealth effects. You can see in the next slide, given the slide in the equity market, this just shows the value of all publicly traded stocks. Obviously a little dated now, but gives you a sense of the slide in total valuation from about 34 trillion at the peak to closer to 27, 28 trillion today. So you do a little bit of arithmetic here, the so-called wealth effects, the relationship between changes in wealth and spending. It's going to be a big hit to spending, particularly among millennials who are very tied into what's going on in the equity market. The demand side shock will also be evident in investment. Business investment is collapsed. That's what's shown here. We run a survey at Moody's that we've been doing since 2003, a weekly survey, ask a bunch of questions. This just shows the response to one of the questions around, are you investing in equipment and software? Last week, not a single respondent said yes. That is unprecedented. Even in the financial crisis back 10 years ago, you could see 25, 30% of respondents were investing. Nobody was investing last week. I don't expect that to continue very long, but that gives you a sense of the magnitude of the pullback by businesses that are shell-shocked by what's going on. International trade also being impacted. Got news today that the president is going to curtail immigration. So globalization, which has been a very important source of growth in the economy, is being short-circuited through immigration, trade, investment, all of those things. So the demand side shock here is going to be quite significant. a very serious shock, body blow to the economy. Okay, part two, the baseline. Well, it's disconcerting. You get a sense of that in the next slide. This shows our assessment of who's going to be in recession this year. I've got 250 economists across the globe. We have folks that track all of these economies and make an assessment, subjective based on data, whether an economy is in recession or will be. And you can see every single country we cover. Some countries aren't shaded because we just don't cover them. We don't have enough information and data. But every country we cover is going to suffer a downturn this year, unprecedented kind of global pullback, which is one reason to be nervous about the strength of any economic recovery. Typically, in recessions, you have a part of the world, a major part of the world that navigates the recession reasonably well and is the engine of growth coming out of the downturn. China played that role, for example, in the financial crisis. No one's going to play that role this go around, and that doesn't augur well for the strength of any economic recovery. One reason to suspect that we will not have a V-shaped recovery. It's going to be something much more muted than that. More explicitly, you can see in the next slide our GDP forecast quarter to quarter, 2020 Q1 through the fourth quarter of 2020, annually 2019 and 2020. I'm showing you the world, the US, and a number of other major economies, what we were expecting back in January, what we were expecting at the beginning of March, and that March update is now the April baseline. So that's our most current forecast. And I just wanted to show you this because of how dramatically things have changed since the last time we got together in January. We've been playing catch up in our outlook. I feel like we've caught up now, but this gives you a real sense of the severity of what we're going to experience. One thing you'll notice is I do expect a bounce in growth in the third quarter, and that goes to businesses reopening. So, we have this downdraft, the supply shock. Once that shock is over, you get this temporary bounce as businesses reopen. But then you can see as you move into the fourth quarter of the year, and I'm not showing it here, but if you looked into 2021, slow or no growth because it's very unlikely the economy is going to kick into full gear or any kind of gear until we have some kind of vaccine or a very effective treatment, which at this point epidemiologists say is unlikely until the middle of 2021. So that's the kind of assumption we're making in our baseline economic outlook. Just to round that out a little bit, you can see our expectations for unemployment in the next slide. This is the US January baseline, March baseline, and now the April baseline. You can see the spike in the second quarter. April again will be the peak in unemployment, 15 to 20%. I do expect as businesses reopen in May and June, that unemployment rate will come back in. But you can immediately see, by the end of this year going into next, unemployment is still in the high single digit, 7, 8, 9, close to 10%. So it's going to be a slog, a struggle, all the way through until we have a vaccine. And then on the other side of that, I do expect growth to pick up. But even then, we don't get back to anything one would consider full employment until 2023 or into 2024. My outlook for the real estate markets is summarized in the next chart. This shows house prices. That's the dark blue line. This is the FHFA house price index. This is house prices on homes with Fannie Mae, Freddie Mac mortgages. FHFA is their regulator. And then our own index of commercial real estate prices, the commercial property price index that we put together. Both the repeat sales indices based on actual transactions. You can see I expect declines in both house prices and commercial real estate values. House prices don't fall nearly as much, in part because of the relatively fairly valued housing values coming into this. Some markets were overvalued out west, but generally housing prices were consistent with incomes, rents, the construction costs. Also, the housing market is receiving a significant amount of support from the government, forbearance for government loans, which are about 70% of all mortgage debt outstanding. And we will see more support, I suspect, as we move forward here. And then the housing market is also being supported by a very significant supply shortage for affordable homes in the lower middle price points, both on the single family and renter side, and that puts a floor, so to speak, under prices. But nonetheless, I expect about a 5% decline, mostly as we move into 2021, because that's when the forbearance expires, and I think we will see some pickup in foreclosure that will put downward pressure on price. In terms of commercial real estate, the hit is much more significant. The reasoning being that this market was significantly overvalued coming into this. Cap rates were very low. I mean, they should have been low because of low rates, but the spreads were even lower. So, and a lot of it was driven by foreign investment into coastal urban markets, which is getting completely undermined by the virus. Those capital flows will be impaired for quite some time. Also, this market doesn't receive the same kind of support from the government. The CMBS market got a little bit of good news. Was it last week or the week before? You can use high quality CMBS as collateral to get liquidity through one of the Fed's credit facilities. But this market's not going to get the same kind of support. And I do expect bank lenders and other mortgage lenders to pull back more significantly on credit. Finally, I do think the demand side of these markets are now going to be under a lot of pressure. Clearly, that's the case in the lodging industry. That's going to be under tremendous pressure. Brick and mortar retail was already under a lot of pressure. That only intensifies. And I also expect the office market now, because of what's happening with jobs, but also I suspect there will be a reevaluation of where people might be working in the future, given all of the changes that will result from this particular crisis. So you can see I expect almost 25% peak to trough decline in commercial real estate values over the next year, year and a half. Okay, let me end by turning to part 3 and the risks, and they're numerous. I should say there are a lot of risks. Some we just kind of off the radar screen. Let's call those unknown unknowns. But then we have a few risks that are known unknowns, and let me mention 4 of those. The first one is obvious. That's the epidemiology of the virus, and you can see here our underlying assumptions around the virus globally. The baseline is the green here, the green block here. We've got downside scenarios, some upside scenarios. There's many other ways this can go. I mean, bottom line, we are in our baseline have a pretty, I would consider, sanguine view of the virus. No real second wave here. I'd be very surprised if we don't see hot spots develop and some partial shutdowns in different regions of the country as governors try to grapple with reinfections, new infections, and going forward as businesses reopen. But I am assuming that there will not be any significant flare-up of new infections or significant shutdown across the country. That's a pretty big assumption, obviously, and that you can go down much darker paths very quickly. We could also get a vaccine much more quickly or a treatment much more quickly than anticipated, so there's upside here as well. But this clearly is, the most significant direct risk to any kind of economic outlook. Second, the Federal Reserve has been, if you turn to the next slide, been very aggressive in supporting the financial markets and system. They've been a very solid firewall between what's going on in the real economy and the system. Zero lower bound, lower capital requirements, liquidity requirements for banks, lower reserve requirements, massive quantitative easing. They've stood up credit facilities that they first implemented during the financial crisis. They've re-implemented them and instead stood up new facilities. So the Fed's playing a very critical role here, ensuring that the economy doesn't take out the system, which is obviously what happened in the financial crisis and made that such a serious, debilitating downturn. So far, so good on that. My baseline assumption is that they continue to succeed in this effort, but I do think there is a lot of risk around this, particularly as we start to see delinquency, default, foreclosure, repossession, business failure, business bankruptcies begin to mount. That hasn't happened yet, but that will. And as that happens, I think the Fed's firewall will be retested. Again, I'm assuming the firewall holds, but obviously a lot of risk around that. Third, around fiscal policy, lawmakers, Congress, and the administration have also been quite aggressive in supporting the economy. So far, $2.5 trillion of fiscal rescue. I'm showing here the biggest rescue package. This is the third rescue package, the CARES Act, $2.3 trillion, $1 trillion for individuals, another $1 trillion for business, and about $300 billion for healthcare and aid to the states to pay for that, to pay for the healthcare costs. There will be another fourth piece of legislation. Congress is working on that now. I expect that imminently. Expands out the small business lending through the PPP program. That'll be $500 billion, so we'll be up to $3 trillion. And in my baseline, I'm assuming another at least $1 trillion in fiscal support, through the remainder of the year. So that's $4 trillion, I'm assuming, in the baseline. That's 20% of GDP. For context, back in the financial crisis, during and after, there was stimulus that was totaled about 10% of GDP. So I'm assuming a fiscal support that's twice as large as what we got in the financial crisis. A lot of risk around this. Politics could enter in as we approach the election, get on the other side of the election. We may not get the stimulus I'm expecting, and if we don't, then the outlook will be diminished by that. There is also an upside possibility we get more support than I'm expecting, but again, a lot of risk. Finally, the fourth risk is governments around the world are borrowing a lot of money, trillions, to finance all of the fiscal rescue packages. I mentioned ours, but ours is just one of many. And there, in my view, will be a debt crisis at some point on the other side of this, much like we had a European debt crisis back in 2011, 12, and 13 in the wake of the financial crisis when European governments borrowed a lot of money to support their economies. The borrowing that's going on now is across the globe. And this particular chart gives you a sense of who might be most vulnerable. The x-axis, the horizontal axis, represents the debt to GDP ratio for these countries. Each bubble is a country, the size of the bubble, the size of the economy. The y-axis, the vertical axis, is the so-called fiscal space. That's the difference between the actual debt to GDP ratio and that debt to GDP ratio beyond which a country gets into a self-reinforcing negative cycle. Investors balk at the debt, they drive up interest rates, that adds to the government's interest payments, adds to their deficits in debt, and you get into that vicious cycle. You can see countries like Turkey, South Africa, Egypt, Argentina, to a lesser degree Italy, obviously Greece, even Japan, have very little or no fiscal space, but all countries are going to be running out of space here pretty quickly as their debt loads rise. And I do think a significant risk here is a debt crisis. In my baseline, I'm not assuming that, but I think the odds of that are quite high, and obviously another thing to consider. By the way, I don't think this should stop policymakers from using all their resources now to support the economy, because if they don't, then the economy is going to get completely wiped out. This picture is going to even look uglier. But governments have a Hobson's choice, really no choice at all. Either you borrow now and hope that you can navigate the crisis down the road, or you don't borrow and you've got a crisis today that's going to be even more debilitating. So lots of risks, not hard to go to the dark side here, even more quickly, more dramatically. A lot of things to be nervous about at this point. Okay, I took my time. I think I got it right on the nose, and I'll turn it back to you all and see where you want to take the conversation.
Thank you, Mark. As usual, it's great to hear your comments. We did have some questions coming in from the audience, so let me pull them over. All right, Mark, I've been listening to you for a long time, and so have many people in the audience. Have you seen any parallels with what's happening now to prior recessions?
No, I mentioned natural disasters. I mentioned hurricanes, as a kind of that's a supply, that creates both a supply shock and a demand shock. But that's, obviously small geography. Everyone can see to the other side. There's not a lot of uncertainty. A lot of money comes pouring in. It doesn't stress out sources of insurance money generally or government aid that comes in. So that's the only corollary I can think of. I mean, 9/11 maybe sorta. I mean, the economy was shut down for maybe a day or two.
Right.
Similar kind of dynamic. People were nervous, a lot of uncertainty, but nothing to the scale of what we're experiencing today. This is just completely off the charts, different than anything we've experienced.
Yeah, I totally agree. Another question, do you think the CARES Act did enough for small businesses? And then a follow-up to that, do you know the status of the additional funding?
No, it's not enough. In the CARES Act, the funding was $350 billion. That we blew through that in a couple of weeks. I mean, you do have to give policymakers credit because they unveiled that program, and within a few weeks, they exhausted the funds. So there's obviously a significant amount of demand and need for that funding. We are going to likely get another $300 billion for the program. I think Congress will pass that, and President Trump will sign it, in the next day or two, certainly this week, and that will be provided. $650 billion in total is not inconsequential. And in fact, if you kind of do some arithmetic, that comes roughly to the amount of GDP that's going to be lost by businesses with below 500 employees, so-called small businesses. If you buy into my outlook, you go back to that first chart and you see look at the way those shutdowns progress, and you count up the total GDP loss. It's about 650 billion. So that they got that rough. I don't know that was by design. I think they kind of stumbled into that number. But the problem with the PPP is the way it's targeted. It's not targeted. It's first come, first serve. And it's really helping companies that are between 50 and certainly 100 employees to 500 employees, bigger companies. It doesn't help the micro companies, less than 50 employees, certainly less than 10, certainly less than 4. Give you a sense of that. There's 8 million establishments in the country, business establishments, 8 million, 4.5 million of them have fewer than 4 employees. They're not going to get help. Now, they're 15% of all jobs, so it's not inconsequential. And so that's why we're going to see a lot of failure unless we have another mechanism for helping those businesses. I don't think the PPP as it's designed or even could be tweaked could reach those micro companies in any reasonable way. So I do know lawmakers are working on a different way, a funding mechanism to try to get cash into businesses' checking accounts, particularly smaller companies. So hopefully that's coming with the next round of fiscal rescue, but it's not going to be with this round. So there's going to be a large number of failures. So it was quick. That's great. It's about the right size. That was pretty good, but it's just not targeted well. And so that needs to be fixed.
Another question in, do you think that this will have disparate impacts on rural, suburban, and urban areas?
I think longer run, when you think about this, I would be surprised if it doesn't have meaningful impacts on the way we live and work. And one of those changes, I think, will be the way we think about urban living. Now, let me say that the move away from urban living was likely regardless of the virus because of demographics. We have a large millennial generation that in their 20s and early 30s were moving into the cities. They are now in their early 30s, fast approaching when they start families and have kids and generally move out to the suburbs to get better schools. So that was a dynamic that was going to play out over the next decade regardless. The other demographic was boomers, me, 50s and 60s, moving into the city, empty nesters. And that likely too would begin to start playing out, over the next decade as boomers now get into their 70s and older, and urban living, just doesn't work in that, in that context. So these demographic trends that were going to play out over the next decade, 15 years, were already in place. And my sense is that the virus and its implications will only accelerate those trends, reinforce those trends. And so that means less urban living, it's not a cliff event, it's not like, tomorrow everyone decides to leave. kind of more of a, we had this tailwind moving people into the cities. Now that tailwind is, basically going to start becoming a headwind, and people are going to start, moving towards, suburban, exurban areas. Maybe even some rural areas might benefit, but I would think suburban, exurban areas are more likely to benefit from this dynamic.
Okay, we got two more questions. As appraisers, we struggle a little bit at the beginning of a crisis due to lack of sales data. I've been monitoring the market. I mean, there have been some closings. The volume is still, obviously way down, but appraisers are always looking for price discovery. When do you think the markets might pick back up again in terms of real estate transactions?
Well, I think on the housing side, that's going to take a while, right? Because you've got all of this forbearance that I mentioned earlier. So if you have a Fannie Freddie FHA loan, that's 70% of all debt outstanding. You can forbear for an entire year. I mean, that means you delay mortgage payments for an entire year. And so we're not going to get true price discovery, I think, until the forbearance is off and we see what happens, with those properties. I expect prices will decline. In between now and then, I do think transactions will be very limited. You'll see some transactions because people do have to sell and they have to move, but they'll be relatively limited. And that's why if you go back and look at that chart, I don't really have house price declines until this time next year.
Right.
And that's the case. On CRE, similarly, I think it's going to take a while before we actually see transactions that give us any kind of price discovery. Just because, first of all, businesses are highly disruptive. I just don't think we're going to see a lot of transactions until more businesses are up and running. Kind of, you get a sense of, how much office space they need and what kind of retail space they need. What's going to happen with hotels. It's very difficult to know exactly what the damage here is and to what degree, and it's going to take a while to sort that out. I don't think we can sort that out until we are more open. Businesses are open, travel starting to come about. So I don't think we get real price discovery. Again, it's going to be another year before we start to see transactions to the place where you can feel comfortable about, okay, that's real. That's a true price or transaction price, not a shadow price.
Yeah. Okay, Mark, last question. So for many years, we were looking to you for guidance on when the recession was going to start. And, a couple of years back, 18 months ago, I think you might have said, maybe summer of 2020, maybe September of 2020. Now we're going to be looking for you to give us an idea of, how long it will take to reach recovery. So you hear different, statements that the economy was in good shape and we should recover quickly, but I think it's gotten pretty deep and pretty rough. So recovery, I think, is going to take a little bit longer than initial thoughts.
Yeah, no, I agree. I mean, the kind of that discussion is revolving around shapes of the recovery. I mentioned V, that's the quick recovery. That seems very unlikely to me. I just don't see that. Yeah, I just don't see it for lots of reasons. I don't think it's an L. That is, you go down and you stay down, unless we really screw up policy, and we can do that. I mean, President Trump's decision not to allow immigrants into the country is the prescription for an L if it doesn't change quickly, because immigrants are key to growth. If we don't have if there's no immigration, working age population in the United States is going to start declining pretty quickly. That's consistent with Japan. That's an L. We're not, you don't get L though unless you make stupid mistakes. And, that's definitely possible. I'm not rolling that out as a scenario, but I don't think that's most likely. So I think it's more likely kind of a U, we're not going anywhere fast. We're going to feel like we're in quicksand. We're going to get a bounce here in the third quarter. Everyone's going to feel pretty good about it, but then we're going to be back in the quicksand until we get a vaccine and it's distributed globally. And we all feel pretty good that, we're not going to get sick if we travel. And then I think things engage and then we're going to feel like we're off and running. But even when we're off and running, it's going to take a while to get back to something that I think we all feel pretty good about, comfortable about, low unemployment, the kinds of feelings we had, just a couple months ago. That's going to be, that's mid-decade, I think, before we get there. And we've got I think this is going to be a bit of a slog. It's not going to be quick fix, and the longer it takes us to get on the other side of this virus, get it back. First of all, make sure that we don't have a second wave, have a treatment, vaccine. The longer all that takes, the more damage will occur, and the longer the bottom part of the U will prevail. So hopefully, we get a little lucky here and we get a vaccine or a treatment. We don't make stupid mistakes about reopening too quickly or shutting off immigration, and we can get through this relatively fast and get going again.
Well, thank you so much, Mark, for your time. I know the Appraisal Institute and the Councilors of Real Estate appreciate your work, and thank you so much for a great discussion today.
My pleasure. Thanks for all. You guys are great. I really appreciate the support, and thank you. Talk to you soon.
Yes, thanks again, Mark. Bye-bye. Bye-bye.
And thank you, Patrick and Mark. This is Amanda Aaron. I'm having some video problems at the moment. So I will introduce our next panelist, Bob Knakal, without video and try to work that out, separately. Our next panelist is Bob Knakal. During Bob's 36-year career, he has sold 1,873 buildings, having an aggregate market value of over $18 billion. He's a graduate of the Wharton School at the University of Pennsylvania and formed Massey Knakal with Paul Massey in 1988. On December 31st, 2014, Cushman & Wakefield acquired Massey Knakal, and in 2018, Bob joined JLL to co-lead the investment sales division in New York City. Bob, nice to see you. I know you can't see me, but we're gonna do this in Q&A style. Actually, let's see if I can get this video going.
No worries, Amanda, and I'll start while you're trying to get your video up. I'd love to say hi to everybody. The Councilors of Real Estate and the Appraisal Institute, and you appraisers out there, if you know me, you know how fondly I feel about the appraisal community and the work that you guys do, and have always tried to be as supportive as possible. So I hope you all out there are safe and healthy and trying to make the best of these extraordinary times. Thank you for that.
So can you see me and hear me at the moment?
I can, Amanda.
Okay, great. Great. So what we're all dying to know is what you're seeing on the ground. What's going on with, particularly, I think, with deals that were in the works pre-COVID. How's it going?
Well, I'll break that down into two different segments of deals. Ones that were under hard contract, and those that were at advanced stages of the marketing program, such that we were maybe close to getting a contract out or had contracts out. The transactions that we had under hard contract, remarkably, have all closed, with very few of them being renegotiated. And I said as far back as 3 weeks ago that I didn't expect that to continue. And sure enough, we have two closings scheduled for this week, one today and one on Thursday. The transaction on Thursday is the sale of a vacant office building to an international bank for their headquarters. We fully expect that transaction will close. And then we have a small transaction that was supposed to close today to a school that was buying it for programming space. And the school had collected a lot of money for their summer programs and had to refund all that money. So that one is a bit more challenging, and we're trying to figure out how we can potentially get that one done, but that is likely not going to close today. So that will be the first one in our portfolio that won't close, but we fully expect that we may have some challenges in May and June getting those transactions closed without some modification, but there are different folks out there with different risk profiles and different motivations for buying or selling. So we'll see what happens there. So relatively good success with the transactions that were under hard contract. With respect to the properties that were at advanced stages of marketing going to contract, those have been more challenging, have been moving very slowly. But we are still making progress on a number of them. And while it's difficult to get to the finish line, we're doing everything we possibly can to get there. And for instance, we have one transaction where we've had about half the leases in a multifamily building reviewed. The other box of documents has not been reviewed yet. And there's a question, do we send the box of documents to the buyer's lawyer? What about the chain of custody of the documents? We've offered to have the whole box of documents scanned and emailed to the buyer, and we're in the midst of trying to figure that out. But that's just one of the examples of things that are slowing the process down. And then a third subset of transactions in the market are the properties that have just gone on the market recently or at early stages, or that we've been hired to sell that have not gone to market yet. And we have quite a few transactions where we've been retained, the marketing materials have been prepared and are ready to go, but we're taking kind of a week-to-week status to check in with the owners and let them know when we think it would be appropriate to launch. Clearly, if a property needs to be inspected before someone can make an offer or a purchasing decision about a property and we can't show it, there's no sense launching it. So, each of the different groups of transactions is behaving a little bit differently.
And for the, in any of these stages, what are you seeing? What differences are you seeing sector by sector? In how?
Okay, well, that also is very interesting. I think that clearly in the and I won't talk a lot about the hotel sector, but depending on what report you read, in New York City, 50 to 80% of the hotels are closed, and the occupancy in the ones that are open very low. And there was no trading in the first quarter. I don't believe there was a hotel sold in the city, based on the JLL statistics. In the retail sector, clearly is the most uncertainty in that sector today, and that is clearly in a wait and see mode to see how that's going to shake out.
Have you been actively marketing, predominantly retail properties, or you treating
we
them
have,
differently?
and some of them have pharmacies or supermarkets, which are still, sectors of the retail business that are doing well. And so those are a little bit easier to market. You also, as a potential buyer, you can walk in and inspect those buildings, posing as a shopper. So you can't really see back of the house, but front of the house you can see, which is the overwhelming majority of the space. So retail is very uncertain at the moment. And office product, we closed a reasonably sized, about a $50 million office transaction a couple of weeks ago. That went off without a hitch. The multifamily sector is still, if it is at an advanced stage in the marketing process, that's holding in all right. The recent court decision that limits the look back on liability to 4 years was a relatively below the radar screen event, but it has a very profound impact on the market, and I think is positive for the multifamily market. In multifamily, the thing that is being most talked about today is rent collection percentages within different asset classes within multifamily, and within different locations. In April, what are they going to be in May and June? And so every different product type is reacting differently. And then of course land, which you don't have to show, to the extent there are willing buyers who are willing to pay what would appear to be a fair price today, there are transactions to be done. And we're actively working on some land deals and have some pretty interesting activity, which is great to see. But that's the one.
I would like to hear more about that. So you, when you say that there are buyers willing to pay a reasonable price, what is that price today for land? How has land?
Well, I'm not going to generalize on a percentage basis. Clearly, it's lower than it was at the peak of the market, but the land market is really, really interesting. And as that is, land is a major part of my practice. And as someone who's dealing in it every day, I feel bad for the appraisers on the line who have to appraise land today, because the differences block to block and avenue to avenue and borough to borough are so different today that it's really remarkable. And so we're really relying mainly on the bidding activity on existing transactions we're working on to give us a sense of what the market is. Comparable sales are almost of no value today.
Right.
It's really more bidding activity. And unfortunately, for appraisers, bidding activity is not public record. So, those
so
of
tell
us.
how short are these bids on development sites in?
Well, it depends. I would argue that the diminution in value, and I'm going to be intentionally opaque, but I would say the diminution in value can be as little as from a year ago, I would say 0 to 5%, up to as much as 50%. And I think it really depends where, what, how big it is, what the intended use is. Is the site there? Are there tenancy issues, or what are the encumbrances? All those types of things come into play, and it's really extraordinarily site specific.
Are there any generalizations that you can provide to give us insight into which types or locations are seeing the 50% discounts versus the 5% discounts?
No, I think, not even secondary, but tertiary locations are seeing big discounts. Areas where you may have predominantly residential rental buildings, and a few people were starting to want to take the chance on building a condominium building in that location, where the market's really not proven for condo, and you're back to rental pricing.
Right.
Or areas where, mixed use is particularly challenging today. Oftentimes a mixed use project, the path of least resistance for mixed use, where you have a significant commercial component and a significant residential component, is to do a mix of hotel and residential, mainly because the core, the columns, the wet columns, it's much more efficient to build residential above a hotel than it is to build residential above office. And to the extent that the hotel market is in the shape that it's in today, you'd probably opt to do office. But for office to be efficient, you have to have a relatively large floor plate. So is the floor plate large enough to accommodate office and then build a residential above? So there are a number of factors, all different types of things that need to be taken into consideration. And, when you look at what the peak of the market was and land values were at their peak in 2016, and I believe artificially so, I think real value was at its peak in 2015. But as we entered, and if any of you read the stuff that I write, you know that my feeling is that the investment sales market in New York City has been in a correcting mode since October of 2015. And I think real value actually dropped in 2016, but the statistics will show that value increased in 2016, but that was accompanied by the quintessential dynamic that we see at the beginning of any market correction, where volume just dropped off the table. So the folks who were able to get their price did sell at that higher level price, but the majority of people didn't get their price, and so volume dropped. And so I'm talking about these percentages I'm mentioning are compared to that 2016 peak.
Okay, and the properties that are getting the least amount of discount now, the land development properties, what are those? You know, what's considered a safe bet in land development?
Well, I think if someone is still willing to do condo today, and there are a number of developers that will build condominiums today, I think smaller is probably better than larger. I think if you're sub 100,000 square feet and you're going to do a boutique condo building, we've seen the value of those sites holding up very well. If you're in a neighborhood that is particularly thriving or has really been on the upswing, you think of Mott Haven in the Bronx, for instance, I think value there is holding very well. So I think it really depends on what you're building, where you're building it, and what the size is going to determine which sites are going to hold their value the best. Got
it. And just a couple other quick questions before we turn it over to Patrick for questions from the attendees. You mentioned, you certainly mentioned the recent ruling, the multifamily ruling preventing lookbacks for rent regulation. And I would just, we don't have a multifamily presentation today, and it would be helpful to hear your perspective on kind of the layering of the rent law change of 2019 with this current crisis. You know, how's multifamily looking now, kind of relative to other sectors with this double whammy that we've had?
Right. It's really interesting. The rent law changes in June 14th of last year were really detrimental to the housing stock. It was detrimental to apartment building values. In the long run, it will be very detrimental to the quality of the housing stock. You know, one of the great things that the city did after the 1970s occurred, where you know, I'm a lifelong Yankee fan, and I remember very vividly watching the '77 World Series, Yankees against the Dodgers, Reggie Jackson's hitting home runs all over the place. And the Goodyear blimp pans out, and there are 6 fires going on within a few blocks of the stadium. And it was economically more feasible for owners to collect insurance proceeds than to invest in their buildings. The MCI program and the IAI program created an incentive for the private sector to invest hundreds of billions of dollars into the housing stock. In the 1970s, the dilapidation rate within the housing stock in New York City was 14%, meaning 14% of the units were uninhabitable. Today, that dilapidation rate is 0.04%, mainly because of those incentives for the private sector to invest in the housing stock. And you see the difference in quality in private sector owned housing from public sector owned housing, and I won't get into that too much. But the new laws basically marginalize those two tremendous programs to the point where there is going to be a significant decrease in the amount of capital investment in the housing stock. Because of that, it created a disincentive for folks to purchase properties. The volume of sales has dropped. One of the biggest trends that we've seen amongst property owners in the multifamily sector is that if they're buying multifamily, they're buying it outside New York now. For the most part, there still are some investors that are very bullish on New York multifamily and are still buying. They have a very, very long-term perspective. But the other trend, in addition to these investors who really for decades have only purchased in New York City, they now want to buy outside the city, multifamily, and within the city, they want to buy other asset classes. They're looking at retail, they're looking at office, which is very interesting. We sold an office building on West 22nd Street recently, and had 242 signed confidentiality agreements on that transaction. More than half of those confis were signed by investors that had never bought an office building before, and many of them coming out of the multifamily sector. So I think that, you know, with this new disruption that has occurred, the big thing that everyone is focused on is what is the level of rent collection, and that has been all over the map depending on the type of building, type of tenancy. Is it free market? Is it regulated? Where is it? What is the tenant base in that building? This disruption has had almost the inverse that the financial crisis has had on the income amongst the folks who have lost jobs. And so the disruption now and the more difficult rent collections we've seen in secondary and tertiary buildings in areas outside of Manhattan. And that's a concern. But all in all, I think that this recent court decision is a very, very positive thing for the multifamily market in New York, and it doesn't eliminate the look back, but it does cap the liability on look back to 4 years. And there are also some presumptions about what the legal rent is based on leases that you have without having to go back in certain cases to substantiate that a unit was deregulated properly or what the rent history was. So a lot of that's a very positive change, I think, for multifamily.
Okay. I'm going to actually have Patrick come on, and we'll take one question from our attendees. We're running a little bit longer than I had hoped, but thank you, Bob, for your insights there. And take it away, Patrick.
You got it. Hey, thank you very much, Bob. Always good to hear your insight. If I only have one question, I guess it will be, how would we compare the great year we had in 2015 from an investment sales perspective to what we might wind up with in 2020?
That's a loaded question. I want to answer it in an interesting way. And I have tremendous respect for Mark Zandi. I think he's brilliant. I will take issue with one thing that he said, that you know, in commercial real estate, it probably will be a year before there are enough data points to draw conclusions about price discovery, et cetera. The interesting thing, and I speak to dozens of property owners every week, and a big subset of those owners are smaller owners, family offices, high net worth individuals. And the most interesting thing that has come out of those conversations, particularly over the last 2 or 3 weeks, is that I believe that the pandemic is having much more of a profound impact on the psychology of people than 9/11 did. And what I mean by that is the conversations I'm having with people revolve around, I think, or emanate from them thinking about mortality. You know, we've had now over 13,000 people that have died in New York. Just about everybody knows somebody or tangentially knows somebody that has passed away, unfortunately. And I think a lot of people are thinking about their own mortality. And I've had a number of investors say, you know what, Bob, I have 99% of my net worth tied up in New York City real estate. What the heck was I thinking? I should sell some buildings and buy in other cities, or I should sell some buildings and just buy T-bills or put cash in the bank. I don't care if I get no return on it. I want to know I have cash there. One client joked around, said, I'm going to go buy 10,000 rolls of toilet paper and stick it in the basement of my Hamptons house. I just think that people are looking at the world very, very differently. And while, yes, we have short memories generally, I believe that we may see a significant amount of selling for the purposes of asset reallocation and reorganization, because people now are looking at their life from 40,000 feet and realizing that maybe a little bit of diversification is a good thing. And so I don't think this is going to happen in the second quarter, but I think these properties may come to the market in the third quarter, and that we could see some robust trading in the fourth quarter of this year and the first quarter of next. So I'm more bullish about when the activity level is going to come back. Now, you notice I haven't said anything about what values will be, and I don't want to go there, but I can tell you I think that we will have enough activity for some good price discovery, probably at some point within late second quarter, early third quarter.
All right, Bob, thank you so much. From the Appraisal Institute and Counselors of Real Estate, we thank you as always.
Always a pleasure to be with you all, and I encourage you all, stay safe, stay healthy, and as always, if there's anything that I can ever do for any of you, please feel free to reach out to me at any time. I love the appraisal community.
And thanks, Bob. Thanks, Patrick. Bob, you're welcome to hang around, and if you're still here at the end and we have a few extra minutes, maybe we can get in a couple more questions. Now I'd like to introduce our next panelist. Our next panelist is Daniel Lesser, a renowned authority on hotel feasibility and valuation. Dan is president and CEO and the founder of LW Hospitality Advisors. He brings more than 40 years of experience in a wide range of hospitality operational, counseling, valuation, advisory, and transactional services. Welcome, Dan.
Thank you so much, Amanda. It's great to be here. I'm a proud member of both the Councils of Real Estate and the Appraisal Institute, and I'm completely flattered to be invited to present. So I think the cover slide of my presentation says it all, and it echoes even further what Mark had been speaking about earlier. There were 4 shocking weeks of unprecedented downturn that has recently occurred in the lodging industry. And if we could just advance the slide. I think before we talk about exactly what's going on, it's always important to kind of take a step back. I mean, people know this already, but hotels are unique forms of real estate. They're going business concerns, and they're married up with bricks and mortar property. They're operating businesses that have lots of employees, and the businesses are very reliant on quality of management, brand identification, and the like. There's no credit tendencies within a hotel. If you think about it, hotel rooms get leased up every single night. The pricing of guest rooms, or average rate, if you will, with technology being what it is, it literally changes by the nanosecond. There are a lot of complexities in hotel investments. You have typically an owner and a sponsor. There's third-party equity, there's debt, there's a lender, there's a property manager. In many cases, there's an asset manager, and then there's a brand, most likely. And those competing parties do not necessarily always have aligned interests. And actually, we're going to see later on in the presentation a classic example, the Gregory Hotel here in Manhattan, but we'll talk about that later on. Hotels, very highly leveraged, high fixed cost businesses that, whether they're 10% or 100% occupied, again, a lot of fixed costs and fixed labor, and then reliance on intermediaries. I mean, it's very visual today that, putting heads in beds is very reliant upon people being able to fly from one place to the other. So again, hotel industry very reliant on intermediaries. If we could advance the slide on this next table, this sort of sets the table, the stage, if you will, for it is absolutely remarkable what's happened. We've had 10 years of growth in terms of RevPAR, or revenue per available room, which is the very simple calculation of occupancy times average daily rate. So 10 strong years of RevPAR growth. Granted, during the last couple of years, that growth rate was diminishing, and it's been a good 24 months that the sector has been talking about the coming downturn. the coming down, and it wasn't coming until the pandemic hit. And then on the bottom part of this slide, again, record metrics, not just on top line, but also bottom line profits. And this is all through December 31st, 2019. Now, if we could just move the slide forward. Of course, coronavirus hit, and as of this morning, the latest statistics are quite grim. We can keep going. It is important to note that the virus is very much concentrated in 6 major markets. And then, once it hit, it was dramatic. It was swift. And both Arne Sorensen, who's the CEO of Marriott International, and Chip Rogers, who's the CEO of the American Hotel and Lodging Association, are on record as saying that this epidemic is worse for business than 9/11 and the 2008 financial crisis combined. Earlier this week, the U.S. Travel Association and Oxford Economics came out with a study that said that from a revenue perspective, the travel sector is going to be impacted more than 9 times when compared to 9/11. I mean, those are remarkable statistics to think about. We can advance the slide. Now, this may be a little bit tough to make out, but this is 2020 compared with same period 2019, hotel market revenue per available room % change. And remember, the metrics from 2019 were positive all the way to the end, and then January was still looking good, it was positive. February, looking good, it was positive. And then the first 4 weeks of March, I mean, it really says it all. These are unprecedented and absolute mind-boggling declines. And as we can see, that after the 4-week dive off the cliff, things have sort of stabilized a bit, where essentially revenue per available room is down 80% over the past couple of weeks compared to the same time period last year. And at the bottom of the slide, we can see some of the major factors that were going on each week as this was progressing. And, unfortunately, on the far right-hand side, which is the latest data that's out, it's really just more of the same, if you will. So the sense is, it really can't get any worse mathematically, and that, we are at rock bottom. Okay, if we can advance the slide. The next table actually shows market by market. San Francisco, Orlando, Anaheim, New Orleans have been hit dramatically and for quite a long period of time. Oahu has been hit dramatically as well. There's no inbound air traffic either from the United States or from Asia coming into Hawaii. And then we can see other cities that were a little bit behind the curve in terms of being affected, but at the end of the day, every major market, and we'll see on a later slide, we can advance the slide, that every submarket in the country is taking a hit. Actually, here's that slide. Every submarket within the United States, 645 of them, have seen decreases in revenue per available room for 4 weeks now. Again, this is just absolutely stunning, mind-boggling. Never seen this before. If you would have told somebody, a couple of weeks ago that this was about to happen, they would have thought you were crazy. Okay, we can move on. And just a little bit of highlight of week-ending occupancies for a handful of markets. I mean, Northern California, 35.8 all the way down to 4.8 in the Florida Keys. I mean, these are weekly occupancy levels. Think about that. 4.8%, or in Hawaii, 6.9%. Okay, we can advance the slide. And of course, the hotel business has always been good at this. Right at the very peak and before the crash, we just experienced an all-time high of U.S. hotel rooms under construction. So it'll be interesting to see, what happens at this point. My sense is not all of them are going to be completed. Many of them will, but a lot of them will not be. But again, all things are really pointing in a negative direction, unfortunately, as of today, April 21st, 2020. Okay, if we can advance the slide. And we can also see that this sort of makes sense that the hardest hit class, if you will, is luxury, and then economy has been the least impacted. However, it's still been impacted quite dramatically. We can move ahead. And again, these are just mind-boggling statistics. This is from Smith Travel Research, and the metrics that they're showing in terms of declines in demand, occupancy, average rate, RevPAR, revenue per available room, 51%. And they're also forecasting 2021 an extremely strong rebound. Again, these are Smith Travel statistics, but I think this chart is important for a particular point relative to hotel values. The notion of the value of a hotel going up dramatically year over year is not unheard of. So just as easily as a hotel value can decline, and interesting, Bob mentioned 5 to 50%. That's what I'm hearing people are talking about. That's not what I believe. I'm going to talk about what I believe in a second. 5 to 50%. So just as hotel values can rapidly decline, they can also rapidly increase, right? So if in fact these numbers come to fruition and revenue per available room declines 51% this year and then goes up 63% next year, obvious values should follow suit. The other very interesting point here is that the lowest recorded occupancy nationally in the United States is about 55%. And Smith Travel is anticipating 2020 occupancy to be 37% nationally. Again, just mind-boggling statistics. Okay, we can keep going. So what's happening with a lot of hotels now that they don't have guests staying there? Well, a lot of them have been converted to accommodations for medical workers, homeless, folks that are quarantining, first responders, and the like. Also interesting, on the far left, Ken Griffin with Citadel Securities took over the Four Seasons in Palm Beach and opened up a trading floor there. So kind of an interesting alternative use. We can move ahead. What are some of the major, particularly publicly traded hotel companies doing? Well, they're shoring up their balance sheet and drawing down lines of credit. At the end of the day, cash is absolute king today, either cash in the pocket or access to cash. And you can see, these large entities are effectuating these revolving credit facilities. Also interesting to note in the lower left-hand corner that Hilton sold $1 billion of loyalty points to American Express and put that right on their balance sheet as cash available for use, which is an interesting transaction. Okay. You can move the slide. Okay. On the debt side, particularly CMBS, the party has absolutely already started, not in earnest at all, but there's already a whole slew of assets that have been moved into special servicing. I think it's fair to say that every hotel in America that has LTVs of 50% or greater as of February 28th, if it's not in special servicing yet, I cannot imagine that they're going to escape it in the next couple of weeks. So that's obviously not some good news. We can advance the slide. And other additional not so good news is hotels that are closing forever. The Hotel Buckminster in Boston, Kenmore Square, a landmark, literally a landmark property, a beautiful hotel, 1000% location. It's closed its doors, and they've announced, the owner, that they're not going to reopen as a hotel. Blackstone is suing a fairly large entity over a scotched $265 million hotel deal. It's interesting. It will be interesting to see how that case evolves, because apparently there was nothing in the documents that said that an event such as a pandemic would allow the the borrower to back out, and so there's obviously a fight over the escrow money. Eagle Hospitality Trust is another publicly traded entity, actually on the Singapore exchange. Rumors in the market were that deal was teetering to begin with, but it actually went over the cliff, after March 1st. And then what I was alluding to earlier about the different constituencies in a hotel investment, there's a fight going on at the Gregory Hotel. Again, this is all in the public domain. This is the bottom of this slide. Pandemic ignites battle over unpaid wages. This is between Meadow Partners and the labor union and Highgate Hospitality. So some big players, battling it out already. So this is all the bad news. We can advance the slide and look for a little bit of good news. What's interesting is that there's already been a fair amount of smart, sophisticated capital that's made bets on this downturn. Airbnb, I'm sure everybody is familiar with, has already gone out for 2 separate rounds of $1 billion each. They're paying dearly for that money, but the fact remains that there's some really smart groups that are within those buckets, within those 2 buckets. The Saudis invested a significant amount of money in Carnival Cruise Lines. Barry Sternlicht, who's got an amazing record, has been a significant investor of Extended Stay America. Starwood Capital has put in over $136 million in buying stock on the public exchanges. So, very interesting. The other one to look at too is the Ritz in London, famous hotel. It actually sold on the same day that it closed for operations. The first time in 133 years, the hotel closed. It sold for just under $1 billion, about $997 million. Again, Middle East money, but just very much shows that smart, sophisticated money sees upside already and is trying to take advantage of it. Okay, we can move ahead. So the $1 million question, right? We get this every single day. Where are hotel values today? And I think it's really important to take a moment and talk about market value versus liquidation value, right? And there are a couple of definitions of market value out there, but this one's very simple, right? Willing buyer, willing seller, neither being under duress, right? At the end of the day, there is not a hotel on the market today that's been placed on the market because there's no distress. First of all, there really is nothing on the market, but anything that is, there's got to be a distress story. Why would anybody sell today? So, if you had to sell today, then frankly, you're looking at a liquidation value, right? And the premise for liquidation value is probably an all cash transaction and no opportunity to leverage with lower priced debt. The bottom line is that nobody knows what the erosion of value has been since March 1st. I think we can fairly much agree that no hotel asset is worth more today than it was on March 1st. The question is, how much lower? But nobody knows, and anybody who says they know is making it up as they go along. I am somewhat amused when I read different reports that say it's going to take between 3 and 5 years to recover. I'm not sure how anybody knows that, because I don't know it, and I know lots of other people who really have no idea and are willing to admit that they don't know. We can move ahead. A firm called Origin Investments, they're a private equity firm focused exclusively on real estate. They don't have exposure in the lodging sector, but they do in multifamily and retail. And they issued a letter to their investors. I think it's hard to see this slide, where they basically acknowledged they don't know. It is hard to read this, but hopefully they'll be able to fix the slide at some point. At the end of the day, they put out a letter to their investors, and this is all online, acknowledging these are smart, sophisticated guys who have more than $50 million of their own personal money alongside their clients' money, and they've acknowledged that they have no idea what's going on in the market, and they have no idea about where values are today. We can move ahead. Lots of folks talk about 2001. I don't believe that 2001 nor the financial crisis are reflective comps, if you will. you know, 9/11 was a one and done deal. But if you do want to sort of look back, this was an interesting transaction that occurred in November, December of 2001. It actually closed, and that was Blackstone acquiring a portfolio of hotels called Homestead Village Suites. And the deal was originally supposed to go down at $900 million. The contract was signed in August. Obviously, 9/11 happened, and then the deal cratered, and it actually then closed for $740 million. So there's some sort of a data point where it works out to about 18% decline. Again, it closed in November, December. My sense is if you were looking, if it ended up closing in October, it might have even been a greater delta, but there's something that you can look to, you know, a ballpark 20% decline. We can move ahead. This is interesting. Ethan Penner with Mosaic Real Estate, a major construction lender. Back in the early 90s, he was with Nomura, and he really developed the concept of CMBS. And he recently came out with a proclamation, and again, that's what shows up here on the right, on the highlighted right-hand side, where he acknowledges that CMBS was originated at a time when there was no other capital available, and it was originated, you know, in the moment for the moment. And the structure of it today, he perceives as being fairly flawed and needs major overhaul. And the reasons for that flaw are now coming to the fore, because the bottom line is that, you know, properties that are going into default that have CMBS debt on them, there's really nobody to talk to, right? You got to go to your master servicer, who then turns it over to a special servicer, and it's not a very friendly way of doing business. So it'll be interesting to see once we do get past this and CMBS does come around, if it does come around, you know, what it will look like at that point. We can move ahead. So where are we now? I'm not going to read through all these. They're pretty straightforward. I mean, at the end of the day, sponsors and managers are clearly, you know, in a defensive position, you know, particularly those that not only manage hotels, but also own the real estate. Lots of hotels are looking for opportunities before they decide to close. They're looking for opportunities to be good public citizens and, frankly, you know, try to cover operating costs to keep properties open. There is a cost with shutting down a hotel and reopening it, and so negotiating various agreements, as we saw on an earlier slide, with cities and government agencies to accommodate a whole slew of patronage, from first responders to quarantine centers and homeless folks. There's absolutely constricted liquidity in the lodging debt markets. There's no financing available today, particularly CMBS, but there really is no financing available, or at least market rate financing. Existing lenders are being very accommodating. They're offering 60 to 90-day interest accruing forbearance agreements. You know, I think it's safe to say that after the 60 to 90 days are up, if things are not looking better, there's probably a fairly good chance that folks are going to get another maybe 60 to 90 days, maybe. But after 180 days, I think the game is going to be over, and all the sharp elbows are going to come out. And with that being said, the private markets, which are flush with capital, they're in an offensive stance, and they're ready to take advantage of the dislocation that's going on. We can advance the slide. The road back, well, we can look to China, I guess, depending upon if we can believe what's coming out of there. But you know, Marriott has already talked about, I think they had shut down 90 hotels, and as of a week ago, 60 were reopened and 30 were closed. Americans are always an optimistic bunch and love to travel, whether they can afford it or not. So that, you know, that's a good sign. And then interesting phenomenon that's going on in China. I'd never heard of this before, but revenge spending, which is now being talked about turning into revenge traveling. So there's a growing population of middle class and wealthy folks in China that have been holed up for weeks now, that, you know, are sitting on cash and have cabin fever. And so they're spending money apparently quite dramatically on luxury goods and talking about going traveling as soon as they can. So it'll be interesting to see, what happens there. That's all the good news. The concerning news is second and possibly tertiary waves. So we got to look to see what happens in Asia, where we're starting to hear a little bit about that, because you got to figure if it's going to happen there, it'll happen here as well. We can move ahead. What's the new normal going to be? Absolutely no handshakes. I was a germaphobe before Donald Trump was a germaphobe, so I totally relate to that. The use of automation is clearly going to be something that has been talked about for a long time, but is finally going to happen. With the use of robots to deliver goods to guest rooms, the use of mobile phones as keys to get in and out of rooms, check-in kiosks, and then of course the obligatory having to have your temperature taken and given a mask if you want to go into the hotel. We can go to the next slide. And then, on the food and beverage side, and also for freestanding restaurants, there are going to be some dramatic changes. I think the notion of buffets are going to go out the window, and definitely more grab and go, virtual menus, bartenders and service workers wearing gloves and masks. Again, robots bringing meals to patrons. And then cleaning certifications. Accor, which is a very large hotel chain, recently launched a COVID-19 cleaning certification. Marriott just came out with one yesterday. Clearly to get the traveling public to feel comfortable about traveling again, cleaning is going to be 100% imperative. We can move ahead. What does the future look like? Listen, hotels that were already over-levered or had stressed cash flows prior to February 28th, they can't be resurrected if they get some sort of forbearance. And there's no shortage of hotels in New York that I think it's safe to say may never reopen as hotels because they were in trouble before this all came to the fore. Capital stacks are going to be completely restructured. It's going to be a terrific opportunity for those who have liquidity and strong balance sheets to delever on favorable terms. Absolute well-located hotels with high-quality sponsors are going to be the beneficiaries of initial capital. Soft brands are going to grow quite dramatically because I think independent hotels are going to realize that they probably took it harder than brand-affiliated hotels on the downside and on the upside. And then supply growth. Supply growth is probably going to be muted by a number of hotels that, again, permanently just never reopen. We can go ahead. The return of air travel and hotel stays is going to be in two waves. First, it's going to be occupancy, and then it's going to be rate. Leisure and visit friends and relative travel should rebound fairly quickly. Some business travel will rebound also fairly quickly, but there's a whole slew of corporate and group meeting and convention travel that may take a long time to come back or may not ever come back. Energy glut, we saw what's happened with oil, so that'll be good for keeping utility costs low. And then obviously biological safety is going to have some permanence going forward. Next slide. And I'd like to leave everybody with this saying that Maya Angelou came up with: hope and fear cannot occupy the same space. Invite one to stay. So hopefully everybody can invite the hope and not the fear. And I wish everybody well, and thank you for listening to the presentation. If anybody has any questions, I'm available either later on or at any point in time. And Amanda, thank you so much.
Thank you, Dan. Thank you very much. And yeah, Dan's going to stick around. We're our program. We have so much to say. Nobody's talked about cap rates yet. We really just want to know what the cap rates are. So we'll have to get to that in the end Q&A. But thank you, Dan. And I'd like to introduce our next panelist. Our next panelist is Ben Friedland. Ben is a vice chairman and co-head of CBRE Alternative Investments Practice, or AIP. AIP is an industry-specific practice group focused on advising private equity firms, hedge funds, venture capital, and other alternative investment companies on their real estate strategies in New York City and around the world. Ben will be presenting on the office, co-working, and flex sector, both pre and post-COVID. Welcome, Ben. You are muted.
Thanks, Amanda. We good now? Okay.
We're good.
Thanks. I want to first thank the Metro New York chapter of Appraisal Institute for having me and for Patrick Craig inviting me to participate. So as you said, I've been at CBRE for just over 20 years, and I've never seen anything like this. And what's interesting about it is there's no playbook for what's happening right now. We're really in a unique moment where everyone's looking for real-time information on what conversations and outcomes are possible given everything that's happening. There's no Bloomberg terminal to look up comps in the system. It's all about conversations that are ongoing right now. So as Amanda said, my team represents mostly hedge funds and private equity firms here in New York. We're very volume heavy. We do over 80 deals a year. So the amount of conversations that we're having right now is very significant. We also represent a lot of private equity firms for their portfolio companies all over the world. So we're having similar conversations across all real estate industries and lines and geographic locations. So I'm here to share some insights, as Amanda said, on the office market and the flex space market. Next slide, please. Okay, so we broke it up into two parts. We're going to do the Manhattan office market pre and post-COVID, and then the co-working market pre and post-COVID. Next slide, please. Okay, pre-COVID, next slide. Okay, so if you take a look at this, this is a slide of basically the last 10 years. And if you look at 2019, the end of 2019, it was a strong time. You know, if you orient to the top right, you can see 31.6 million square feet leased. That's second only to last year's 32.4. And total velocity, which I view as a better metric, it's leasing plus renewal deals. It was the most active year in recent history with 39 million square feet leased. And if you look in the bottom right corner, you see the average asking rents at $80.43 was a high for the last 10 years. And what I'm about to say, it's amazing how much the focus has shifted. In my world, what tenants were focused on at the end of Q4 and the beginning of Q1 was, how do we densify our space? How do we max out our headcounts, particularly for the big tech firms? How do we get huge floors with big floor plates where we can put everyone in together? Groups are very focused on the company experience, amenity space, and then what landlords would provide to those companies in terms of amenities, gyms, and things like that. Groups before were very focused on new construction, and we'll talk about whether that's going to continue now. I would say the midtown high-end market, which again is my core competency, had started to show some cracks pre-COVID as the supply-demand metric really shifted a little bit with additional offerings for these groups in the Hudson Yards and other boutique buildings around the city. That market, because the supply-demand ratio is off, it started to show some weakness. Next slide, please. So this slide, I included, it shows the breakdown of the New York City occupancy by industry. And while tech and other industries continue to grow, what you can see here is New York City still has a strong bent towards financial service companies. That said, diversity is one of the main reasons that I'm bullish on New York City long term, and I'll end this on an optimistic note when we get to the end of it. But it's this very diversity that makes New York City so special. I've watched in the last 10 years as tech has come on more and more in the city, and it's because of the talent that's available here, not just within their own companies, but the ancillary talent, the attorneys, the accountants, the marketing, and then the customers. That whole business ecosystem is here. And while I acknowledge that in the future world, we're going to lower the amount of these sort of interactions that need to happen, there are going to be certain global cities where this is a place where it happens, and I believe New York is going to be one of them. So similarly, we're seeing the exact same thing in the life sciences industry now, where they had been focused on Cambridge, and now a lot of those groups are coming to New York for the same reasons that the tech did. Next slide, please. So this is a slide of leasing velocity, and what we tried to do, and as Dan, the last speaker, had said, you can't really compare everything because every situation is unique, and certainly certain events are one-time events, and these are, COVID is long-standing. But two things that we can get out of this chart is that obviously, if you look at September 11th and Bear Stearns, there was the leasing velocity slowed considerably after those two events, which we expect to happen here. And then renewals. In times of uncertainty, people look to punt impactful and capital-intensive decisions. So how that translates to real estate is more renewals. So we expect to see, similarly to after the other two events, we see renewals as a percentage of overall deals really going up considerably. Next slide, please. So that was before, this is now. Where are things going? So again, all of this is information that's in real time. These things are happening right now. I would say that the last 6 weeks have been some of the busiest of my career on the phone with clients, talking them through these issues. But unlike where Dan Letzer's lodging has felt the impact already, and it's very clear, my market has not seen any statistical changes. So just to give you a sense of it, since COVID, almost no space has been put on the market and no space has been repriced on the market. And I know that can sound incredible to groups outside of the real estate world, but the reality is it was too new at the beginning. No one knew what the parameters were for negotiating deals, so not that much had been happening. And there are really four key types of conversations that are going on right now as a result of COVID. There's the retail or office tenant that is going to go out of business unless the landlord works with them. This is mostly confined to retail, and they're able to make a compelling case that the landlord needs to renegotiate something with that retailer, or else they'll have empty space when the market reopens and retail is already depressed and they'd have empty space. So those deals are being worked out on the retail front. Then there are the tenants that were mid-negotiations when COVID hit. So we've got a lot of those right now. Again, all of our clients basically put things on pause. And now landlords are starting to come back and try to add sweeteners to the deal to get some of these groups to move forward. Then there's tenants with upcoming lease expirations, and landlords are aggressively approaching them now to try to work out any renewal deals that they can. And then lastly, there's tenants with long-term obligations, just in their lease, in the middle of their deal. And some of those groups have gone back to landlords to claim hardship if they're not able to pay the rent. But for the most part, there's been less to do on those than other conversations. A big part of this, it's worth noting, also depends on the type of landlord that you're dealing with, whether it's a REIT, a private equity firm, a family. Each has their own unique interests in the deal and how they're able to move around money. So one of the critical components is understanding who's on the other side and what is and is not achievable for them. So some predictions. Right now, construction is halted, and once the floodgates reopen, the industry is going to have to deal with an already historically active construction group, plus every single tenant in New York City trying to figure out in a post-COVID social distancing world what changes they need to make to their space. So the construction community is going to be overwhelmed. So that will have all types of ramifications on our market. First of all, there's the domino effect. If one group can't get into new space because it's not fully constructed, then the group that was going to occupy their space gets delayed, and so on and so forth, domino effect. Tenants in the market, while everyone smells blood in the water, the reality is that a lot of the spaces that are raw now will be much harder to transact on because who knows when they'll be able to get constructed. So we think there'll be a premium for built space in the foreseeable future. There's been a change from tenants wanting to construct their optimal space to let's just see what works, and again, punt big decisions. Newer buildings, which were already very desirable over the last few years, even though they're a small percentage of the overall stock, the amount of interest in leasing in the new construction buildings is a very significant percentage of the overall leasing. We expect that to continue, especially with things like air filtration systems and other health benefits being better in new buildings. Next slide, please. So this is a slide of subleases as a percentage of overall availability. And what you can basically see is that after 9/11 and 2008. The general band is within 15 and 25 points, but after 9/11 and the financial crisis, the sublease availability spiked to 45% and 30% respectively, and I anticipate a similar spike in the coming months. This spike in subleases is going to force landlords, put pressure on landlords to sweeten their offerings, particularly when they, again, have raw space versus build sublease space. Next slide, please. Okay, co-working. Next slide, please. So next slide, please. Pre-COVID, flex was the story. There was 827% growth since 2009. In 2009, they had 57 locations, and in 2019, 445, up to 16 million square feet, which is 4.1% of the overall stock of space. Everything felt up, up, up. Then there was the WeWork fall. It was a very salacious story. It captured everybody's attention. By the way, if anyone wants to hear a great version of the story, the podcast We Crash, very entertaining, only 6 episodes, highly recommend it. Just 2 weeks ago, Knotel laid off 40% of its staff, Convene 20% of its staff, WeWork another 250% of its staff. So what is going to happen to this industry? Next slide, please. The answer is it's very complicated. So there's lots of negatives and positives on the flex space. So let's start with the negatives, then we'll go to the positives and then prediction. Occupiers, here are the negatives. Occupiers, the easiest space for people to get out of is the flex space. So any of the large groups that have flex space and normal space, to cut costs, they're going to get out of their flex space first. Competition, subleases are going to flood the market, and that's going to put competition on the flex space. It's well documented that some of these groups did not pay their own rent in April, and you can imagine it's hard to collect rent when you're not paying it yourself. So we'll see how that continues to play out. Groups will obviously be hesitant to sign leases, even short-term ones with these groups. And then one of the biggest challenges is that landlords were already starting to get into this game, and they said, why should we pay WeWork or Knotel to make this type of space? Why don't we create it ourselves? And we have all these inherent advantages of we run the whole building. We have other groups inside that could use it. We should do this instead of paying a third party and not let the third parties in. So I think that was and remains a major negative. All that said, there's a lot of positives. Again, in times of uncertainty, occupiers need and demand flexibility as the number one thing. And flex space is just so much more flexible than your standard lease. It also allows groups to avoid capital in a time where they don't want to, and move-in solutions at a time where we said there's going to be a real focus on move-in condition options. Tenants, so much so that tenants, even with leases rolling, may elect to, instead of moving to new space, punt, do a short-term renewal on the space that they have, and even if they were growing, maybe they take some flex space again to figure out where they're going to be in 18 to 24 months from now. So my opinion of the future for flex is that it will continue to consolidate. It'll be profits going to become harder as the PE and VC capital dries up. These flex operators are all renegotiating their leases right now with landlords. We'll likely see more management type arrangements like Industrious does with a few groups where the landlord and this group are in it together financially. But overall, big picture, not sure who the providers will be or what manifestation it will come in, but flex space is now an important part of the New York City real estate ecosystem, and it's here to stay. That's what I got. Any questions?
Hi, thank you, Ben. And I'm looking. That was very interesting. And if you can hang around, I'd actually like to move the Q&A to the end of the webinar for any panelists who are still here. I know we have so many questions from the attendees, and I do want to make sure that we have time for our final presentation within the 2-hour window that we originally scheduled. Great. So I'm going to introduce our next and final panelist, Timothy Quinlan, who will be addressing the retail sector. Timothy Quinlan has 20 years of experience in real estate, primarily in New York City as a multifamily and retail investor and developer. For the last 13 years, he's run Quinlan Development Group, a 50-year-old private real estate company that owns multiple multifamily, office, and storage buildings, including approximately 200 retail stores in New York City. Tim, welcome. Can we see you and hear you?
You can see and hear me. That's good. That's the first win of the day.
Excellent.
Thank you for having me. Thank you for asking Bob also all the questions I had for him and other panelists. It was very interesting. I was paying attention the entire time, and to the Institute for including me today and giving me a reason to shave this morning.
We're glad to have you here, and we're going to do this Q&A style, just conversationally. And I know you have a diverse portfolio. We are particularly interested in that retail space. Obviously, retail has been really hard hit by this crisis. So tell us, how dire is the need of your retail tenants? Are they closing shop temporarily, permanently? What are you seeing? What kind of rent concessions are in discussion?
Well, I would say outside of hotels, retail is probably the second most adversely impacted real estate asset type. It's obviously very dire. I'm speaking mostly to bricks and mortar right now and not online. E-commerce, that's a totally different subject. There's no money coming in. It's a real problem. The situation's very dire. Unless you're a liquor store, a grocery store, pharmacy, maybe a pizza place, there's very little reason to be open right now. Even if you're considered an essential business, like a restaurant, in New York City, and the restaurants run on such thin margins, unless you're crowded Wednesday, Thursday, Friday, Saturday night, you're not making money. So delivery is not enough to justify staying open. Anecdotally, I heard this morning from a restaurateur that I know that he actually had a difficult time finding delivery people, not just for fear of COVID, but also because unemployment was paying better than being a delivery person. So that was interesting. Currently, we don't have any official closings. We're in a bit of a standstill, a frozen period. There's definitely talk of having to hand back keys. I think the real result and ramifications, the carnage, if you will, of the shutdown won't be fully realized until the economy starts opening again, and how long that takes. I think it's going to be pretty tough. And I would point out that most of our portfolio are small businesses. We do have credit tenants, but it's really, these guys are hurting, and it's a tragedy because a lot of these owners work very hard for their businesses. They have family members involved. It's a 24/7 venture for them, and they're not necessarily getting all the support that's needed. So there's a lot of tough conversations we're having.
So what are you doing? What are you doing about concessions requests, forgiveness,
Right.
forbearance? How are those conversations going? And what kind of collections are you seeing or do you expect to see?
Well, I've spoken with 98% or so of our commercial retail tenants. The other 2%, I suspect, will call me after this. And we basically handle it as a case-by-case situation. We look at credit levels, strength of the operator, likelihood to survive, the percentage of income that it brings to the property, previous behavior. Are they open? Again, is it a pharmacy or is it a gym that has to be totally closed? We ask for financials. We look at all that, and then we make a decision and work with them. Our company's philosophy is to maximize occupancy always, especially now. So we're working with them. We always start with trying to get paid current as much as possible, but the fact of the matter is we're deferring rent for the most part. Sometimes it's month to month. Sometimes we're giving 2 or 3 months runway. We've done very few abatements at this point, but I suspect a lot of the deferred rent, when it comes time to pay that additional rent, it's going to be difficult, and some of that will be abated. I don't know. It all depends on how fast we get back up and running. A lot of my colleagues are applying security to rent payments. We've done that in 2 cases so far. I suspect we'll be doing that more frequently as this bleeds into May and possibly longer. I would caution people to maybe check their loan docs before doing that. We've tried to help the smaller businesses with the PPP, they've all been on top of it. They've been fantastic. They've already had lending institutions. The issue is, I think we've only had one who's been paid anything thus far. And then in terms of the credit tenants, I'm somewhat disappointed in some of them in that I get form letters saying they're just not paying rent. I send a form letter back saying, well, you kind of have to. They negotiate leases with me, they get better TI, maybe more free rent, and then when push comes to shove, they're not there. So I think it's time for everyone to do the part that can. Ultimately, they're going to owe it.
What's that credit worth when it comes down to it, right?
That's, they certainly didn't mind using that factor in the lease negotiation, but when it matters most, I'm getting a legal form letter. So if they can step up, they should. It's really the small businesses that are hurting. The larger companies benefit from the socialization of the credit markets that the Federal Reserve and the government did. The smaller businesses don't have that kind of access to capital. So,
I think again, I'm sorry to interrupt. We've got a bunch of appraisers and people who value real estate listening and watching this, and what kind of assumptions should we be making? How are you looking at your expected collection loss in the next 3 months, 6 months? Do you have any sense of it?
Well, every week or every time the governor speaks, it changes. Cuomo, our governor in New York, it's a difficult time to be an appraiser or a broker now because there are no transactions. There are very few comps to look at. And I would hope that everyone just takes these next few months and throws them away because they're not going to be pretty. We went into this just assuming a blanket 3.5 month total commercial retail collection loss that was a ham-handed way of blending lower current pay, abatements, deferments, lost tenants. As we have now actually gotten our first monthly AR reports, and I can tell you this morning's was 13.7% collections for the month of, so that's not great. So that's the first part data I have. We do look at it building to building and try and gauge and guess as best as we can on which tenant can pay what, et cetera, to see our run rate. But
that's your April collect on the retail, just the retail component?
Just commercial retail. I thought our multi depends on the building. I think it was Bob or someone earlier mentioned that it's all over the map depending on the building profile. He's right. On the low end, it's 82%. On the high end, it's 93% in terms of our multi collections. Okay. So those guys are paying much more so far. I mean, unemployment, that might lag a little bit, but the retail, businesses are closed.
So what does this mean for the conversations that you are having or will be having with your lenders?
Well, we started our conversations quite early with our lenders in early March, just as a heads up and get a line of communication going. I don't think it's done much for us because they've suddenly gotten slammed and they're overwhelmed. I think it depends what kind of lender you have. Is reference, I think it was Dan or someone earlier mentioned that if you have a CMBS lender, I don't know who you talk to on a good day. We're fortunate that we mostly have traditional commercial banks, so there's someone on the other end of the line, but we're not getting a ton of attention yet. And I think they're doing what I'm doing, which is triaging the most immediate issues, whether it's a hotel or a retail condo that's lost, its anchor tenant or something. What we've seen is either mostly form letters that are providing some principal or interest or both deferments for 1, 2. We haven't seen 3 months yet. Someone earlier mentioned 3 months, and we haven't seen, nor have I heard about forbearance yet. But that might be coming.
And in terms of the big picture, I guess I've got 2 final big picture questions for you. So back to, focusing on retail, what do you, obviously retail was challenged pre-pandemic. What of those trends are being exacerbated? What do you see, the long-term changes, structural changes in this market in your portfolio, or specifically for our city in terms of the retail landscape?
That's a big question, and I know we're all running late here. So
in 30 seconds.
I'll buck the trend and be concise because I'm not known for that. We're known for going down rabbit holes. Well, as you pointed out, retail was a bit like a 80-year-old with pre-existing conditions going into this. Rents had been going down, vacancy going up. In some places, rents were where they were 10 years ago. The variety of tenants looking at our vacant spaces had gone from 5 or 7 different users down to 1 or 2. This kind of dental person or this kind of pet support place. That was what we're going into. The Amazonation or e-commerce was already having its impact, and locally there'd just been a ton of legislative burdens put on the retail sector. That was a double whammy for them. In the near term, it's just severe loss of income, mass store closings. A few weeks ago, I told someone that vacancies could exceed 30%. That sounded a little crazy as I said it myself, but I'm starting to believe it. I think tenants are going to renegotiate leases to lower rents just to stay in place. As a landlord, I wouldn't necessarily want to face a vacancy. I agree with Mark and others that I don't think there's going to be a quick bounce back here. There's no V. Until there's a vaccine or an effective treatment, confidence is going to keep people away from shopping centers or movie theaters or crowded bars, and paychecks have to start coming back into. It used to be before e-commerce, as a sort of pseudo appraiser, retail rents were a function of the purchasing power of the neighborhood, as my father always said, and that's not necessarily the case to the same degree. I think there is a major creative destruction. I think it was Ellen Greenspan said retail is reforming itself. Trends that were taking place that might have taken 5 years to get to, we've done in 5 weeks. It's really e-commerce and how we interact. I have a few stories of the older generation who might have done Amazon, but now realizes they can do everything online, including banking, auto pay, and automatic refills. It's hard to break that addiction. It's easy. So I know I'll stop there, but retail needs to redefine itself and find its footing.
I appreciate that. And for the kind of the magic question for appraisers and people who value real estate, what's the number? What's the cap rate today? Where, how does someone do a deal, or what are market rents today? What's a cap rate? I'd love to hear what your thoughts.
I'm behind the previous panelists about their zero market or business investment sentiment. Bob Knakal, I think he said things are challenging. Until we see where rents stop falling and vacancy stops rising, and ideally there's some vaccine or the threat of a double dip alleviates, it's very hard to know what value is. In a frozen market, when there's no transactions, it's hard to value anything. It's a bit like a few weeks after Lehman crash. No one wanted to dip their toe in the water first. So it's a tough. Unfortunately, I don't have a cap rate because each situation is different, and I don't know how long this is going to last. Every day is like a month in this situation. Ultimately, I'll say when I'm done being a pessimist, I'm always an optimist, and so these are the times we do invest the most or are the most active, and there is a lot of money out there. And when the dust settles and the distress works its way through the system, whether you believe in hyperinflation or you're just hungry for yield, money will come back to retail.
Are you a buyer then? If these are the times that you invest, are there going to be opportunities for you? I know.
I certainly hope so. We have 2 offers out on 2 development sites, multi. They're at land pricing that is where it was about 8 years ago. So I feel like I can wait out a few months and I'm okay. But I will also point out that they have almost no retail component, which right now I just think is going to be very hard to finance. So that's mostly multi-focused.
Are you seeing multi as the, I'm going to ask you the same question. This is the last question I'm asking, and then we're going to get everybody else back on for some Q&A. But how are you? I mean, you're also a multifamily landlord, and I know the rent law of 2019 hit the values for rent stabilized properties pretty hard. Is this making you rethink that? You know, the value of that component, or is that starting to look a little more positive?
Well, I'll say, like a lot of others, we were looking at outside markets to invest in for multi. We were leaving New York behind, which is crazy for me to say, but we never really leave it behind, right? I'm a New Yorker, it's in my blood. Always looking at those listings before I look at something in another state. I'm definitely scared of legislative risk. There's more downside than upside 2 months ago. Now, if I can buy land cheap enough to, and that's, you know, if I have land at a good enough basis, that's my insurance policy, I can weather some legislative risk. So it's really a function of getting the right opportunity at the right price right now, because I have to counteract the immediate legislative risk that's out there. But long term, I do believe in New York, and I live here, and I love it here. We're there because I'm not here right now.
Okay, thank you so much. So whoever's still with us on our panel,
you want me to, by the way?
Stay on, Tim, stay on. I'm gonna pop my video off, but if Patrick could come back on, and any other of the panelists who are still here with us who have video, I realize we're at our 4:02, but if anybody wants to hang around, I think there's some great questions, and I'm going to let Patrick let you all field them.
Okay, great job, everybody. This question is for Ben. So how will the pandemic change how office tenants use their space, social distancing and everything?
Yeah, it's definitely a great question that we've gotten a ton in the last 6 weeks. I think the answer is similar to the overall market, which is it's still too early to tell. We see a lot of people who are home who are saying, I can work from home, and in some ways it's better and I want to do more of it. There's other people who are home who are saying, I never want to do this. I think there's a lot of challenges that people haven't thought through in terms of the amount of space that they would need, because historically when groups would have a work from home component, especially for people who weren't in the office a lot, they would have hot desks at the office for people to go into, in shifts. In the new post-COVID world, are people going to share desks, or even if you work from home, are you still going to need your dedicated desk at work? So I can just tell you that from the conversations that I'm having, no one knows any of the answers to this yet. They just know that it is going to change. I do think one permanent change, they say COVID's the great accelerator. The idea that working from home is a cop-out will go away, right? That's just gone for good. So if someone schedules their week where they've got only calls on Wednesdays and they go in Monday, Tuesday, Thursday, Friday, unless someone can show a real reason why that doesn't make sense, I think we're going to see a big push towards that. But again, it's still very early.
Okay, thank you very much, Ben. Question for Dan. And this is from Bob Knakal. He said, how many hotel rooms do you expect to see converted in New York City to other uses? Dan, you're on mute.
Great question, Bob. Listen, it's going to boil down to highest and best use economics, right? You know that better than anybody. As I said earlier, there was a whole slew of properties that were at the edge of the cliff, pre-C-19, and a lot of them are never going to reopen. What they're ultimately converted to and how many, I don't really have a good idea about specific numbers, but I think it's fair. I'm fairly confident in saying that there are definitely assets that will not reopen as hotels. And New York is a little bit unique, right? Because you have the whole union labor situation. And, you know, depending upon, you know, whether there's any give on those contracts, it's going to determine economic viability to reopen as a hotel or not.
Cool. Thanks, Dan. I had Bob had one follow-up question too. Do you expect to see a lot of debt sold on hotels?
That was for me.
Yeah, that's for you, Dan.
Absolutely. I think you're going to see all types of instruments that are attached to hotels, resorts, and the like, trading for sure.
Thanks,
Actually,
Dan.
there's already a deal that was in the market pre-C19, the Williamsburg Hotel in Brooklyn. Newmark is pitching the debt on that property.
Very good. So this one is another question for Ben. So there's a lot up in the air. We all know that, working from home, working remotely. Have you seen forecasts on what this pandemic is, you know, going to do to demand on office space?
No, not yet.
Too early.
You know, it's still too early. I mean, even again, the sublease space coming on, you think about these big corporations, they're just figuring out now what the layoffs will be. Then they have to figure out how do they reconstitute their space and put everyone together and which space to put on the market and for how much. So it's taking time to go through. It's not close to there yet.
Yeah, Ben, would it be fair to say that a big component of that decision-making process is going to be the experience that folks have working from home? How different industries do, how different components of businesses do. I mean, it's interesting, you know, from a brokerage company perspective, it's interesting to see some divisions are working really, really well. And, you know, for other divisions, it might be better to be together. I think it's at the 2 or 3 months into the experiment will be the time to tell what works and what doesn't, I think, right?
Yeah, I think you're right. And also when things like this happen, you know, the pendulum swings far. The same thing happened with open office space, right? It was the new thing. Everyone's doing it. Bloomberg ahead of his time. Then everyone went to all office and people said, wait a minute, there's actually specific tasks where people are better off being in their own space with audio and visual privacy to concentrate and creatively, things like that. So I think it'll be the same kind of thing. Everyone will think that it's a bigger percentage than it is, and then it'll go back to an adjustment of, and will be firm specific. You know, it depends on what your roles are and whether you physically need to be there or not.
Hey, Bob, I have a question for you and also for Tim. So we keep hearing about a lot of dry powder waiting on the sidelines. Have you guys seen opportunity funds starting to form? Have you seen those opportunistic buyers pop up like we see in prior recessions?
Well, I have to say, with deference and respect to all of the folks who are investors, many of whom are my clients, everybody's saying they have dry powder and they want to buy distressed assets. You know, the question is, are you willing to pay the market clearing price? Clearly, everybody would buy for pennies on the dollar, but when you look at what a reasonable price is, and I have no idea what a reasonable price is today. We're in the process of figuring that out. But I think there are a lot of folks who are contrarian in their thinking and are ready to be aggressive and have raised some funds. There are a few people I've spoke to over the weekend that have available shocking amounts of capital to buy transactions and want to deploy it, and I don't believe they're bottom fishers. So it'll be interesting to see how that unfolds. But we need to see, and one of the interesting things, Mark mentioned that the economy is going to come back very incrementally, and we're going to need to see tangible signs of activity before things get back to somewhat of a normalized market. I think that the real estate business is going to, particularly the capital markets in real estate, is going to bounce back much sooner than a lot of other businesses, because all it takes is a psychological switch. And once there is some light seen at the end of the tunnel and people get the sense that, hey, there's a market is going to occur, and there'll be a little bit of clarity, people can make a decision today, hey, I'm going to go buy. And so once you have that optimism in terms of the psychology of the market, I think the real estate business can turn on very, very quickly and much sooner than other businesses. So I'm optimistic about the dexterity that our industry has relative to its psychological backdrop. Much more so, we don't manufacture widgets, so we can move based on a thought process. And so I think that once we get some optimism, I think the industry is going to move very rapidly.
I'd like to just add to Bob's point in the hotel sector. It is somewhat amusing. Every day we're getting calls too from a whole variety of folks who claim to have dry powder. The reality is that there is a lot of smart, sophisticated capital that is available, and in the hotel space, listen, there's no shortage of deals that are that really don't have compelling stories. But when the opportunities come up that do have good stories behind them, I believe what you're going to see is the smart money is going to end up bidding up those opportunities. And I don't see anybody necessarily stealing assets anytime soon.
Yeah, Patrick, if I could ask Tim a question, actually, I'd love to.
Sure. Please do.
Tim, you mentioned your negotiations with a lot of your retail tenants, and given where the market is today, and the uncertainty that retail is looking at, how are they going to get back to business? For a restaurant, for instance, will there be a limit on, is it going to be 30% or 50% or 90% or 100% of their old capacity is going to be the new capacity? They probably have no idea what they could possibly afford to pay. So that's going to create tremendous challenges for you in terms of negotiating with tenants, because none of these tenants know how quickly their businesses will respond. How do you deal with the uncertainty about, what June, August, and October are going to look like for these tenants when they probably don't have any idea themselves?
Yeah, as a business owner, they all want the longest period of relief as possible, which I understand. As a landlord, I am dealing with much more incrementally in month to month or maybe 2 months, because I don't know what things will look like in June, because things are moving so fast. I don't know which types or uses will bounce back faster than others. I suspect I'm not going to be going to a Guns N' Roses concert this summer like I thought I might, but who knows? I mean, the analysts the 20-year-olds in my office couldn't stop going to bars until the government made them stop going to bars. So maybe bars bounce back. I don't know. So I'm dealing with it incrementally. You're right. Restaurants are my biggest fear. I know one of my roommates is a large restaurateur who we'd all know. I speak with him all the time. He's written in the Times, etc., about the death of the restaurant industry. I speak with my restaurant tenants all the time. We all know how hard it is to run a restaurant in New York City. We also all know how important restaurants are to New York City. And they, as I mentioned earlier, they run on such small margins. And so unless you're packed, you're not making money. And when are they going to be packed next? Who knows? And so I've heard things, they're looking at ways to implement technology. Maybe we've seen this in some European cities where you don't have a server, you have an iPad to enter your order into, and there's just someone roving around to answer your questions. what can they automate? How do they cut down on expenses? But it's just really murky now and scary because you know, a lot of these businesses are so important to the vibrancy of New York City, and the future's murky. So it's almost like dealing with it on a month-to-month, week-to-week basis at this point. And they're trying to redefine their businesses and how they operate themselves.
Thank you, Tim. We've had a number of questions pop in, Bob, and this is for you, about the capital markets and if there are segments that are more active than others. And let's just say there's a quality asset out there. Would you be able to get financing on a transaction these days?
Yeah, I don't want to talk too much about financing, but there are lenders that are still very active. Not very active, but relatively active, more than you would think. So I think that, you know, to the extent you have a solid property and a solid sponsor, our mortgage brokers are very, very busy, and there are lenders that are active. So yes, the debt is definitely available.
Well, all right. Amanda, do you think we have more time, or?
How many more questions do you have? You know, I think we could take a few more. I love to give the panelists another opportunity, but if not, we can wrap it up.
Yeah, I mean, there's plenty more questions, but another question, a typical appraiser question is, you know, and again, you know, this is probably more for Bob, but probably for Tim too, is if you're sizing up a deal, how is your underwriting change? And I know, obviously, we got a collection loss issue, so you probably model that a little bit higher. Your rent's probably going to be a little bit lower. What other, you know, parameters are you shifting or focusing on?
Do you want me to go? Yes and yes. As Bob referenced, there is financing available. It's not as competitive or cheap as it might have been. So I'd be looking at lower leverage. I'd be looking at perhaps slightly higher interest rate, higher spread over LIBOR. You know, this is a weird period, but if from an appraiser standpoint, you have to put something in the model. And so those would be the main inputs. You know, I'd look at rents and whether it's residential, maybe reduce them 10% and retail 20%. I don't. You have to do something if you have a lease that's over a year old. That's. I mean, in the meantime, it's tough to do an appraisal of a property now. I think I referenced that earlier. I don't envy anyone right now.
Yeah.
You know, we've actually, Patrick, we've actually come up with a highly analytical algorithm to determine value now. We have a really big dartboard with different percentages on it. And we blindfold ourselves, spin around 3 times, and then try to hit the board. And it's worked out really well. We've been...
Well,
sounds like the old college days. That's good.
I'd like to pipe in, though, and actually direct that question to Dan, because Dan, you're an appraiser and you're valuing hotels in addition to, you know, forecasting what's going to happen in the future. So what are you doing? What are you doing for cap rates? And
I'm putting on a blindfold. I'm turning around 5 times and then throwing the dart and trying to hit the board. I learned that from Bob. So I was on a call earlier this week with 4 CFOs of each one of publicly traded entities. Actually, 3 of them were publicly traded. 1 was private. And the topic of market value came up. And each one of these gentlemen said that they had no idea what market value was. And the reason being that there really is no market out there. Right? I mean, there's nothing that's being brought to market. There are no willing sellers. Liquidation value, again, you know, we can come up with that all day long. how are we doing it if we have to do it? Obviously, you need to, place a marker in the ground in terms of what is the assumption of return to operations and then some sense of normalcy, right? So is it, is it October 1st that you start some sort of a projection of income and expense? Is it December 31st? I mean, I don't know what the answer is, but if you have to come up with some semblance of value, you obviously have to start a projection at a certain point of time, and then build up to a stabilized year of operation. And in the past, where a new hotel might take 2 to 3 years to build up to a stabilized level, today, looking forward, that 2 to 3 may be more like 3 to 4, maybe even 5 years. Another sort of back of the envelope thing that can be considered. I definitely would not suggest anybody value a property this way, but if you were to take actual in-place net operating income for a property, 2016 or 17, or an average of the two. 2019 was an all-time high. 2018 was close to an all-time high. So the thinking being 16, 17, or an average of the two is sort of representative of a stabilized year. And then whatever capitalization rate was applicable at that point in time, adding a factor of X. Anywhere between 100 and 300 basis points, obviously very dependent on the particular asset, its condition, location, et cetera, et cetera. And if you did the math, you're probably going to come up with somewhere between a decline of anywhere between 5 and 50%. And the beauty in doing a market value appraisal today is that it's going to be hard for anybody to prove you wrong.
I think that might be a good place to end it. Thank you very much. Yeah, thanks so much to our panelists. It was very interesting presentations, discussion. We appreciate your time and your insight. And all right, so I'm going to close out. Neil, do you want to come back on the video?
Thanks. I'll be right back now that there's room for me. Terrific. Thanks to everyone, all the panelists. This really was very informative and very useful and very real time. And all of us, both on the counselor side and the Institute side, just crave the real time, on the ground observations from people like you. So thanks to all of you. Thanks to all of our attendees. And I'll just say, if you like what you've heard, watch for emails from either or both of the organizations for future update sessions like this. This is, information's coming in minute by minute, day by day, and as they say on NPR, sometimes things may have changed by the time you hear this. There'll be a different set of facts in the not too distant future that will need to be incorporated into our thinking. So we want to keep everybody as informed as we possibly can. Thanks to everybody.
Thank you.
Thank you.
Thanks.
Bye, everybody.
So long, everybody. Stay safe and healthy.
So long.
Take care.
Thank you.